Hello and welcome. It's Thursday, May 15th, 2025, and you're listening to the 39th briefing from Finwell Daily. Let's kick things off today with our financial fact. Get this. Over 55% of Indian retail investors hold less than 5% of their portfolio in international equities.
That's quite telling, isn't it? It really highlights that strong home bias we often talk about.
Exactly. People stick to what they know, even with global markets opening up. Interesting stuff.
It certainly is. Familiarity plays a big role, but it does mean perhaps missing out on some diversification benefits.
Right. Okay, let's get straight to the market action for you today. As of the close at 3:30 p.m. IST, the Nifty 50 had a really strong finish.
It did indeed.
Closed at 25,048.20. That's up a hefty 381.3 points, a 1.55% gain. Pretty
That's a
significant.
very strong showing for the large caps.
And the mid-caps weren't left behind either. The Nifty Mid-Cap 150, it closed at 20,779.05, up 141.15 points. That's 0.68%.
Saw gains there, too.
Yep, and small caps also joined the party. The Nifty Small Cap 250 ended the day at 16,155.50. That's up 117.20 points, or 0.72%.
So broad participation, it seems.
It really does. The Nifty Total Market Index reflects that, closed at 12,805.70, gaining 156.60 points, which is 1.24%. So, yeah, a positive picture across the board for equities.
A good day for the bulls, certainly. Makes you want to look at what was behind it all.
Definitely. Now, quickly on bonds and currency. The 10-year Indian bond yield actually eased a bit, down to 6.310%. That's down 2 basis points.
In the drivers there, likely RBI action, maybe some bond buying, and those lower inflation prints helping sentiment.
Exactly. But the rupee, weakened slightly against the U.S. dollar, closed at 85.59. That's down 0.37%.
FII outflows perhaps putting some pressure there.
Seems like the most likely reason, yeah. Some foreign investors taking money out. So a bit of a divergence, strong equities, easing yields, but a slightly weaker rupee. Interesting mix today.
It is. The bond yield easing is supportive for equities, generally speaking, but you always need to keep an eye on those FII flows and the currency impact.
Right. So let's dig into this market rally. The Sensex surged, 1,200 points? Huge move. And the stars were realty and IT stocks.
Yes, those sectors really stood out.
So what's driving this? Well, two big things, it seems. First, inflation is cooling off here in India. Remember April CPI? Just 3.16%. Really low.
Remarkably low, yes.
And that's got everyone thinking, the RBI might actually cut rates. Maybe in June. Could be 25, maybe even 50 basis points.
The expectation is certainly building, and lower rates are typically a big boost for interest rate-sensitive sectors.
Like banking and realty, right? Makes borrowing cheaper, stimulates demand. It's almost like a direct shot in the arm for them.
Precisely. For realty, cheaper home loans drive demand. For banks, potentially lower cost of funds, though they need lending to pick up too.
Okay, and the second factor, hopes for rate cuts in the U.S. The U.S. inflation data, CPI, came in at 2.3%. Lower than maybe some expected.
Yes, that fueled bets that the U.S. Federal Reserve might start easing up soon.
And how does that help us? Well, think about our big IT exporters, Infosys, TCS. They were up, 2-3% today?
Correct, because a potential softening of U.S. rates, maybe a slightly weaker dollar eventually, and just better global economic sentiment, that's all good news for their export earnings.
Makes sense. Their services become more competitive, and they earn more rupees for their dollar revenues.
Exactly. It's a clear link between global macro events and our large cap IT performance.
Now, shifting gears slightly, let's talk about some news items that were making waves today and maybe influencing sentiment.
Okay.
One thing that seemed to settle nerves a bit was the Supreme Court delaying its decision on the WACC Act. That had been creating some uncertainty, right?
Yes. Any major pending legal decision with potential economic fallout can create market jitters. So a delay in this case seems to have been taken as a temporary positive, kicking the can down the road, perhaps.
Right, removes an immediate question mark. Then something pretty exciting. Greece Electric Mobility filed for a massive IPO. 1,000 crore.
That's significant. A big boost for the EV space.
Yeah, it really sparked excitement in the EV sector. And apparently, it's even attracting interest from NRI tech investors. It just signals how much momentum there is behind EVs in India.
It's a strong validation of the growth story there. Attracting that kind of capital, both domestic and international, is very positive for the sector's development. We'll likely see more such activity.
And, something else that always seems to have a market effect in India, the IPL.
Ah, yes, the cricket effect.
The buzz around IPL 2025 seems to be giving a little lift to media stocks. It just shows how social trends connect to market sentiment.
Absolutely. The advertising revenue and viewership associated with IPO are huge for media companies.
But it wasn't all positive news flow. Indigo's flight disruptions are still ongoing, and that continues to weigh on travel sentiment, obviously hitting airline stocks.
A reminder that operational realities can really impact specific sectors regardless of the broader market mood. You need to look at both the macro and the micro picture.
Definitely. Okay, let's try and break down these key financial and economic points a bit more formally.
Let's do that.
So point one, that low inflation, 3.16% CPI. It's the bedrock for these rate cut hopes. 25, 50 basis points maybe from the RBI in June. And as we said, positive for banking, positive for realty.
Correct. That's the core macro driver right now.
Point two, the Greaves Electric IPO. It's not just an IPO. It signifies robust investor confidence in the EV sector's future here, and it's pulling in NRI tech money too.
A major milestone for the Indian EV narrative, for sure.
Point three, the IT surge. Infosys PCS up. This wasn't random. It was a direct reaction to that softer U.S. CPI number, fueling Fed rate cut hopes, which is a clear positive for our export-driven IT giants.
Yes, the connection is quite direct. Global factors driving domestic sector performance.
Point four, gold. It dipped slightly, about 1% to 92,890 per 10 grams. Why? Well, less worry about inflation means maybe less demand for safe havens right now.
Safe haven demand eased off a bit.
But, and this is important, gold is still seen by many as a crucial hedge against, all the other global risks out there. It still has a role.
Absolutely. Its role as a portfolio diversifier and hedge against uncertainty remains relevant, even with minor price dips.
And finally, point five. Big news on the tech self-reliance front. The HCL Foxconn semiconductor joint venture got the green light.
A very significant development for India's semiconductor ambitions.
Huge step. And naturally, that gave a nice boost to semiconductor-related stocks today. Building that domestic capability is key.
You've summarized the key moving parts very well. Inflation anchoring rate hopes, specific growth stories in EV and semis, and global factors hitting IT and gold.
So putting it all together for you, the listener, what are some key investment themes emerging from all this?
Well, based on today's developments.
First, banking and realty look positioned to benefit if those rate cuts do materialize. Makes sense, right?
Yes, the rate sensitivity is high there.
Second, EVs and semiconductors. Clearly high growth sectors attracting a lot of attention and investment. Definitely ones to watch.
Long-term growth potential seems significant in both.
Third, IT. Potential for more gains. Maybe if the global economy holds up and U.S. rates ease, benefiting exports.
The outlook there is tied quite closely to those global factors.
And fourth, gold. Even with the dip, consider it as that portfolio hedge against, well, the unexpected.
Still a relevant part of a diversified strategy for many investors.
Now, super important. Risks. Always consider the risks. What should you keep an eye on?
Definitely potential trade issues. Maybe U.S. tariffs could resurface. That would hit exports.
Good point. And also, those FII flows we mentioned. If foreign investors keep pulling money out, that could pressure the rupee in the market overall.
Sustained outflows are always a headwind.
So thinking about asset allocation, and look, this is just a very general idea, not advice, but maybe something like 60% in larger, more stable companies, perhaps 30% in mid and small caps for growth, and then 10% in debt and gold for balance and safety.
That's a plausible starting point for a balanced approach, but it absolutely must be tailored to individual risk tolerance and goals.
Critically important. And everyone should be watching that RBI policy meeting in June very closely. That could be a major market mover.
Absolutely. Monetary policy decisions are key inflection points.
Hey, just jumping in here for a second. If you're finding this daily breakdown of the market useful, if you want clear insights without the jargon, then you really should subscribe to the Finwell Daily Brief.
We bring you the essential news and analysis every single weekday.
Don't miss updates that could impact your investments. Just hit that subscribe button wherever you get your podcasts or audio briefings. It takes 2 seconds.
And if you want to discuss things further, have questions, or just connect with other informed investors,
find SOS Finwell on LinkedIn. We'd love for you to join the conversation there. Seriously, connect with us. And promotional message. Okay, before we wrap up today's briefing, I really want to zoom in on something crucial. It's a type of stock market scam, a manipulation tactic that you really need to know about. It's called wash trading.
Yes, wash trading. It's unfortunately something retail investors can fall prey to if they're not careful.
So what is it, basically? Imagine someone or a group buying and selling the same exact stock over and over again, almost simultaneously.
The key is that there's no real change in beneficial ownership. They're essentially trading with themselves through different accounts.
Exactly. Why would they do that? It's not to make money from the tiny price differences. No. The goal is to create artificial activity. Fake volume.
They want to make the stock look like it's suddenly very popular, very much in demand.
Right. So here's how it typically works. They use maybe multiple accounts, executing rapid buy and sell orders. This creates these sudden, noticeable spikes in the trading volume figures you see.
And for someone watching the market, perhaps you seeing that volume spike.
You might think, whoa, look at all the action in this stock. Something big must be happening. Maybe I should buy in quick before it goes higher.
That's the trap. It creates FOMO, fear of missing out.
Precisely. And as genuine investors like you get lured in by this fake activity and start buying, the demand pushes the price up. Then, the manipulators who created the illusion in the first place,
They sell their shares at this artificially inflated price to the unsuspecting buyers.
leaving those later buyers holding shares at a high price, which often then falls back down once the manipulation stops. It's often used in stocks that don't normally trade much low liquidity stocks because it's easier to create a noticeable percentage spike in volume there.
Yes, manipulating volume in a highly liquid stock is much harder and more expensive.
So, what are the red flags? How can you spot potential wash trading? First, be suspicious of huge volume spikes in a stock if there's no actual news, no earnings report, no big announcement to explain it.
Volume without a corresponding fundamental reason is a major warning sign.
Also, watch out for patterns of really rapid buy-sell trades happening again and again in short bursts. Does the activity look unnatural? Trust your gut sometimes.
Repetitive, seemingly circular trading within short time frames.
And always ask, is there a real reason for this frenzy? If you can't find one, be very, very cautious.
Healthy skepticism is your friend here.
Okay, so how do you protect yourself? Number one, verify trading volumes. Don't just rely on your broker's screen, maybe. Check the official data from the NSE or BSE websites.
Go to the source for reliable data.
Number two, be incredibly wary of stocks showing those sudden, unexplained activity surges. Don't just jump in because it looks hot.
Avoid chasing momentum blindly, especially if it looks suspicious.
Number three, always consider talking to a SEBI-registered financial advisor before making investment decisions, especially if something feels off. Get a second opinion.
Professional advice can provide valuable perspective.
And finally, if you do see activity you think is wash trading or any other manipulation, report it. Contact SEBI or the exchanges. You're helping protect market integrity.
Reporting suspicious activity benefits all market participants. Stay informed, stay vigilant.
Well said. Okay, let's do a quick-fire recap of today. Indian markets rallied strongly, Nifty up over 1.5%, led by realty and IT.
Driven by hopes of rate cuts, fueled by low domestic inflation and softer U.S. CPI data.
We saw positive news flow around the EV sector with the Greaves IPO filing and semiconductors with the HCL Foxconn JV approval.
These point towards promising domestic growth areas.
Gold dipped slightly, but remains a potential hedge. Key themes to watch: banking realty on rate hopes, EV semis for growth, IT on global factors.
But keep risks in mind, potential tariffs, FII outflows, and monitor the RBI's June policy closely.
And critically, beware of manipulation like wash trading. Check volumes, question sudden spikes, seek advice, and report suspicious activity. Protect your capital.
Good summary covering the opportunities, risks, and necessary precautions.
Absolutely. If you got value from this briefing today, please do hit that subscribe button. We do this every weekday.
And don't forget to connect with SOS Finwell on LinkedIn for more discussion.
We'd love to hear from you. Now let's end with a quote from the great investor Philip Fisher. He said, "The stock market is filled with individuals who know the price of everything, but the value of nothing."
A powerful reminder.
It really is. As you make your investment decisions, try to look beyond just the daily price noise. Think about the real underlying value of what you're investing in. That's our final thought for you today. Thanks for tuning in to the Finwell Daily Brief.
Thank you for listening.